Hi again, class. In this video I'm going to finish walking you through this declining balance depreciation problem. This would be part 2 of the problem. In the first video I walked you through the depreciation schedule, and in this video I'm going to walk you through these last 3 requirements, which include journal entries and journalizing, and this is how we get this information into our financial records. So again, I'm going to refer to this problem with the picture of the cows in the corner, and we will be focusing on journal entries. So let's go ahead and get started. Again, I've blown up the information so that it's more viewable for you, and right here, this is what we're going to work through. Entry 1 would be for purchasing the cows, and we're going to assume that was done with cash. So let's pick out some information from this problem that is really critical that we do understand this information to do the problem correctly, and the information is right here for this journal entry. We purchased 2 of these cows for $1,000 each. That's going to be our cost, and we're going to follow the cost principle laid out by GAAP and put the cows into our records at cost. There's no freight, there's no taxes, there's nothing else that needs to be considered in this purchase, which is pretty atypical, but we'll go with it. So I'm going to jump to this page for journalizing, and we'll put the date that we actually purchased the cows, which would be July 12th, 2010. You can refer back to the problem to get that date. And I love to show you the T account, so I'll do that up top here before we do the journal entry. And the first one, we know we're going to have cash that is affected. It's increased on the debit side, decreased on the credit side, and we know as a result of this purchase our cash goes down by $2,000. So I'm going to go ahead and put a debit for $2,000 and a credit for $2,000 because we know debits have to equal credits. And I'll just write cash in here. We just explained why. Now the question is, what goes here? What goes in the debit? Well, we're purchasing a fixed asset. I'm just going to call it cows. It's an asset, so it follows the same debit credit rules as cash. And our cows are increasing as we just bought them. So we now have cows, and we're going to represent that with a debit of $2,000. So there we go. We've just gone ahead and answered number 2 here. Let's move on to number 3. We're going to enter the depreciation for the first year, and I'm going to refer back to the depreciation schedule that I walked you through, and we're going to pull the information off of here. I'm going to switch colors just so it sticks out for you. And look at, here's year 1. I didn't switch the colors. Hold on. There we go, I'll use green. This is year 1, and I'm going to pull the depreciation expense, which comes off of this column, and so having the schedule becomes so convenient at this point. All I'm going to do is pull this $400. I walked you through the video on how we got that. And so look at the date I'm going to use though. It's December 31st of 2010, which is when we record our adjusting journal entry for depreciation. Again, I'll do the T accounts up here. I've got one for depreciation. I'm going to abbreviate, depreciation expense. And expense has increased on the debit side, decreased on the credit side. And then we have accumulated depreciation, which is a contra asset account. Here's my asset account. Contra just means it's contrary. The signs are going to be contrary, so instead of an increase being on the debit side, an increase is on the credit side. So what I'm doing when I record depreciation is the expense is increasing, and so is the accumulated depreciation. So I'm going to debit depreciation expense for $400, and I'm pulling that off of the first year in the depreciation schedule. And I'm going to credit accumulated depreciation for the same amount. Pretty straightforward journal entry. And so that records the journal entry for the first year. Okay, that brings us to the most difficult journal entry, which is to record the disposal of the cows. And so let's go to the journal entry. Before we do that, though, there's four steps I'm going to take you through to get this. One is to I call it bring the depreciation up to date. What do I mean by that? Well, when did we sell the cows? Probably not at the very last day of the year, probably not December 31st, and I'll prove that right here. We sold them on April 28th. So now we've got an issue. We have owned it for part of a year. We owned it all of January, February, March, and we're going to assume all of April, so 4 months. And I haven't recorded the depreciation yet, so I'm going to do that step number 1. Well, how do I do that? Let's go to here, and it's going to be on April 28th of 2011. It'll look very similar as far as the accounts. We're going to debit depreciation expense, and we're going to credit accumulated. But the amount is what we're questioning, and we know that it's going to be for 4 months. But how much? And if we go to our depreciation schedule, look at it. We're in year 2 now, 2011. But this 640 you might want to be tempted to use, but that would be the whole year. We didn't own it for the whole year. Instead, we only owned it for part of that year, which works out to 4 months. And we know that there's 12 months in a year. If I divide that by 4, that means there's 3 increments of 4 months in there. And so I'm going to divide this thing by 3. And that's going to give me $213.33. That's the amount I'm going to use to bring the depreciation up to date. $213.33. Okay, so that's step 1. Step 2, I call it record consideration received. What did we get for selling this? Right here, look at I got $650 for each cow, so for a total of $1,300. Now we're going to start constructing the journal entry for the disposal, and this disposal happens the same day, 4/28. I received cash. Cash is going up. Again, here's the cash account. I'm going to represent that with a debit of $1,300. Oh, sorry. Sorry about that. And what I've got here is I have just done step number 2. I've recorded the consideration received. And again, we're walking through the steps to record the disposal. Step 3 is going to be remove the asset. Let me show you how we do that. Right now I have cows of $2,000 in my records, but I just sold them, so that's misleading. I got to get it out of there. To get it out of there, it needs to be 0, so I have to credit the cows $2,000. So I'm going to skip a couple lines here, and I'm going to credit cows $2,000. That's this step, remove the asset. I've done that, that, and that. Now step 4, remove the accumulated depreciation. Let me show you how we do that right now, and that's why I like the T accounts. We would post this amount in here, so we have 400, and then we'd also have another amount of 213.33. Why do we have to get rid of this? Well, we got rid of the cow. The cow is now 0, so the corresponding accumulated depreciation has to be 0 as well. Well, how do we make it 0? We debit it, 613.33. So I'm going to debit accumulated depreciation 613.33. And at this point I've got a space missing, which is okay because debits don't equal credits, and that would bring us to, there's actually 5 steps. This one's done. And that's to record the gain or loss on the disposal. How do we do that? We plug it. If you add these up, you have a total of $1,913.33, which means that I'm short on the debit side by a total of $86.67. So $86.67 will get us into the rules of debits equal credits. And what do I call that? You know, I got to pick an account here. This is where we put either a gain or a loss. Well, how do I know what to pick? This is the way I logically work through it. I got rid of cows for $2,000. I only received $1,300 in cash, plus the use, the wearing out. I wore them out 6/13/33, and I'm short. So I kind of got the short end of the stick there. I didn't get my full value out of the cows when I got rid of them, so therefore I got a loss. Loss on disposal. And that is the journal entry for the disposal of that fixed asset. So that brings us to the end of the problem.